Hi, welcome back to this course on infrastructure finance. This is lecture 27 and we will start this lecture on public private partnerships. So far we have been talking about project finance markets, and this lecture will focus on public private partnerships and what are the various features of public private partnerships, and that is something that we will look at in today's lecture. But before we do that, let us first discuss the thought questions that we actually discussed in the previous lecture. And the questions were, the first question is, how does getting a higher credit rating benefit the project? So before we actually discuss the answer, let us for the time being kind of ask the question, how does one get a higher credit rating, and is it something that can be obtained on a fee? For example, can we actually give a certain amount of fees and then get a better credit rating from a credit rating agency, or how do we actually go about get a higher credit rating? And for that we will have to first a little bit understand about the credit rating process itself. And the credit rating process starts first with the project company approaching a credit rating agency and requesting them to do a credit rating of the project. And once a credit rating agency takes up the assignment, it requests for various information on the project from the project finance company, and the credit rating agency then carefully studies all the material provided by the company, and then it does a certain amount of due diligence on its own, and it also has various levels of personal discussions with the project company, and then it comes out with what is called as a preliminary credit rating. Okay. And once the agency assigns a preliminary credit rating, it then discusses with the company before a final rating is issued. So during this meeting, the company has the opportunity to respond to the various queries raised by the rating agency, and if the queries are resolved satisfactorily, then it can potentially result in a higher credit rating. So essentially the rating process is a very careful study of the information provided by the company, analyzing the various risks, analyzing the financial cash flows of the project, analyzing the guarantees and the other support mechanisms from the sponsor companies and so on, and based on that credit rating is issued. So for doing this this process of rating, then the agency needs to be paid a fee, and who pays the fee? The fees is actually paid by the project company. So the question now is it possible to actually get a higher credit rating by paying a higher fee? Now that is not possible. Irrespective of whatever the rating is given, the rating assignment itself has a fee, and that is what the project company needs to pay. A better credit rating means better characteristics of the project, that is better risk management, a higher degree of comfort in terms of margins or in terms of support, in terms of guarantees, in terms of purchase agreements, supply agreements, and so on and so forth. So naturally if a project needs to be awarded a higher credit rating, that means the projects would have actually provided a lot of background work in terms of mitigating the various risks involved in the project. And why would a project company do this kind of additional effort for a better credit rating? So the benefit is a project that has a higher credit rating is able to raise capital at a lower cost. Simply put, in a project loan, the interest on a project loan will be lower for a project with a higher credit rating as compared to a project with a lower credit rating. So therefore the cost of capital becomes lesser if the credit rating is higher. So this is a very important advantage as far as getting a higher credit rating is concerned. So the second question is, what is the difference between issue rating and issuer rating? So we will again try and understand the difference between issue rating and issuer rating. So what is an issuer rating? Okay. So an issuer essentially is an entity, it's a company, and the company can actually issue various bonds. So for example, an issuer can issue series A bonds, it can issue series B bonds, it can issue series C bonds, and so on. So each one of those issue will have its own purposes, its own characteristics, and so on. But all these three issues are being issued by the same issuer. Okay. Now agencies can also rate the issuer, and whenever the rating is done of the issuer, then it becomes an issuer rating. So an issuer rating is applicable across all the issues that is issued by the entity. Okay. So let us say for example, if NTPC comes out with, let us say 4 or 5 issues of bond offerings, and if an agency has done credit rating of NTPC as an issuer, then the issuer rating is applicable across all the bond issues that NTPC comes out with within a given time frame. But in the case of an issue rating, that rating is specific for a particular issue. Let us say for example, series A issue has a rating of, let us say, AA. So this rating is specifically with respect to the various characteristics of the series A issue, in terms of how strong are the cash flows, in terms of how good is the risk going to be mitigated, in terms of what is the security that is being provided to the investors, and so on and so forth. Okay. On the other hand, series B issue can have a different credit rating. For example, the series B can have AA plus credit rating, because that issue characteristics might actually have more protection as compared to a series A issue. So this is the difference between a issue rating and an issuer rating. So as an investor, you need to be very clear about the rating that you are seeing in any particular issue. Is it particular to that issue, or is it a general issuer rating? The third question that we asked is, what are the issues in private placement of bonds with institutional investors and retail investors? Okay. So we talked about bonds, and we said bonds can be privately placed with financial institutions. So this is institutional investors, financial institutions, and then you also have what is called as your retail investors. So when bonds are being sold exclusively to financial investors, that is called as your private placement. So this is called as your private placement. So in the sense that it is not available for the general public, only certain institutions that are contacted by let us say the lead manager, the book runner, will be in a position to subscribe to this bond issue. And when bonds are being issued to retail investors, it is called as a public offering, because any members of the public can apply and subscribe to the bond offering. So the question is, which one should we actually go for? Should we actually go for private placement, or should we go for a public offering? So there are the features associated with either of those, and let us try and understand what are the various issues involved. Let us say for example, we are trying to when you are trying for a private placement can be faster, because the people who are investing are all knowledgeable investors, and it is possible to conclude the transaction much faster as compared to making a public offering. In a public offering, the compliance requirements are fairly strict and very time consuming. So therefore one needs to actually be able to estimate and budget for the additional time required for a public offering. So the criterion is, if you want to actually raise a certain amount of money quickly, then the best way would be to go for a private placement as compared to a public offering. Okay. Second, in a private placement, since we are largely going to be dealing with banks, or we are dealing with let us say large financial institutions, the way these institutions appraise the project might be very different from the way retail investors will look at. Okay. So these financial investors will take a long term view of the project rather than what is what is basically the current. Okay. So it is possible to actually raise money for certain projects in private placement as compared to the public offering. So there is what is called as concept called hot market. Okay. Sometimes when there is a lot of changes in the market, but if they do not actually affect the project, then it is going to be very difficult to raise a public offering, simply because of the fact that the market perceives as the conditions to be very unfavorable. So we have seen several conditions. So for example, the beginning of the year 2000, there was what is called as East Asian crisis. So the Asian crisis was not pertaining to any particular project, but it was largely towards the entire economy. So under these circumstances, it was very difficult for the projects to raise capital from the retail investors, simply because there was nobody willing to invest. So it was like a contagion, and the entire market was affected. But there was investment happening, even though it was not very large, but there was investment happening in the private placement basis. So when we want to actually when we are planning to actually raise money from the retail investors, we have to be aware of the fact that if there is any sudden downturn in the market sentiments, it can actually affect the way in which you are going to raise capital. The third is the comfort of, let us say, the book running lead manager or the investment banker who is responsible for raising the capital. Now it is generally felt that the investment bankers find private placement a lot simpler, a lot easier as compared to a public offering, because in the case of a private placement, one needs to actually approach a very small group of investors and then try and raise capital, in the sense that the entire process become a lot more manageable, and as compared to a public offering, where one needs to actually do a lot many road shows, will lead to actually reach out to a lot more players in the market, and raising money from a large number of investors is going to be very difficult. In a private placement market, it is also possible to get an estimate in terms of what will be the interest rate that would interest the investors. Okay. And this will help us, this will help the project in terms of making a very accurate cash flows in the initial stages. But in a public offering, it is very difficult to get a feel for what is going to be the interest rate, because the interest rate that will be of interest to the investors will be determined through a process of road shows that are going to be conducted. So the actual cost at which we will be able to raise capital is largely determined in the very last phases, and therefore making very accurate estimations in the initial phases becomes a little difficult. On the other hand, there are some advantages in retail investors as well. It is possible to raise very large sums of capital through retail investors, and it is also possible to raise it is also possible to raise debt with a very long tenor in the retail investor category. So it is up to the book running lead managers, it is up to the project to decide how they would actually go about placing the bond issue, whether it is private placement or whether it is retail investors. There are advantages, there are limitations for both, and it has to be very context specific. It has to be also dependent on the conditions of the market at the point in time the bonds are being issued. Okay, now let us look at the topic of today's lecture, which is public private partnerships. So if you are reading the newspapers, you will actually find news items pertaining to public private partnerships on a fairly regular basis. In fact, the few days back I looked at the paper, and it has a screaming headline which says the government goes into PPP mode to award massive infrastructure projects. So PPP is a topic that is today capturing the attention of policymakers, that is today capturing the attention of government across all levels, and government is very keen to implement public private partnership specifically in the infrastructure sector. We have actually seen the reasons as to why this is the case in the first few lectures of this course, but uniformly we get a feeling that governments would want to actually engage in PPP mode more actively. So they are doing various ways in which this can happen. They are actually trying to formulate policies that encourage the use of PPP. If PPP is being used by state governments, there is an incentive that is provided by the central government whenever they are following a PPP framework, and governments are also training a lot of officers within the government so that they are aware of what is PPP, what are the various features of PPP, so that whenever a project comes for appraisal, they would be in a better position to decide whether it can be implemented by PPP or not. So what is all this thing about PPP? PPP essentially, the full form is public private partnership. It is also sometimes called as 3 Ps, PPP, so therefore it is 3P. So we will try and get some very broad understanding of what is PPP first before we get into the details. So the question is all private infrastructure PPP? Okay. So when we look at the term PPP, it is public private partnership. Okay. So we can have several instances where the infrastructure projects may not really have any public sector participation. So many infrastructure projects can be entirely privately owned, privately operated. So in those cases we do not really call them as PPP projects. Let us look at the power sector. There are several power projects in the country which are exclusively owned by the private sector. So these are all projects, these are private projects, these are infrastructure projects, but these are not essentially PPP projects. So these are all not PPP projects. So PPP projects are essentially a subset of a larger private infrastructure projects, but at the same time all private infrastructure projects would not qualify to be called as PPP projects. So the next question that we have is all project finance projects PPP projects? So we have been dealing with project finance for several lectures now. So are all the projects that are using project finance called PPP projects? Okay, the answer is no again. Why? Because various reasons. First is project finance is not only seen in infrastructure sector, but generally speaking we also see it in several other sectors. Okay. So therefore project finance is a very broader concept, and not all of them are actually public private partnerships. Okay. Public private partnerships generally seen in infrastructure, all forms of infrastructure, not only economic infrastructure but also seen in social infrastructure, so on, but all of them, all of the project finance projects are not again PPP. Okay. Many of them can be exclusively private sector financed. So let us say for example today we have several power projects, right? We have GVK power, we have power projects being executed by Reliance, we have power projects executed by so many other players, even in the unconventional energy sources like solar and so on. So these are all essentially private sector power projects and cannot be really called PPP projects. The third question is are all PPPs project finance? The answer to this question is yes, because the PPPs are an entity on their own. They are entities that are clearly distinguished from their parent companies or from the sponsor companies, and in many instances PPPs are created with a specific purpose, either to create a separate project, either to operate a particular project, and so on. So therefore any PPP project that are being financed is financed on a project finance basis. Okay, so when you look at a broader form of PPPs, all of the PPPs generally speaking follow a project finance route, and that is why we have been looking at project finance in a fairly detailed way, because most of the PPPs that we see in infrastructure today will essentially be following the project finance route. So that's just to get conceptual clarity. So you have, let us say, an university of an universal set of projects that are private infrastructure, and then you have a set of projects that are project financed, and then you will actually have a small set, you will actually have a small set within this intersection, which will essentially be your PPP, right? It will essentially be your. What is a PPP? How do we actually describe PPP? So there are numerous definitions that are abound, but we will look at some very commonly understood definitions of PPP. You know, when you actually look at a text that talks about PPP, you might find an entirely new definition, right? Or you might find several sets of definitions that complements to whatever I am going to say in this lecture. But nevertheless, what I am trying to give you is a very common understanding of what PPP is all about. So the first point in a PPP is a contractual agreement of shared ownership between a public agency and a private company. Okay, so very clearly there are certain important terms here that we need to be aware of. There is a contractual agreement of shared ownership. Okay, so it is not ownership that is exclusively by the public agency or exclusively by the private company. It is a shared ownership between the public agency and the private company, and this shared ownership is governed by a contractual agreement. Okay, and the contractual agreement clearly specifies the duties, the responsibilities of the different shareholders, the rights of the different shareholders, and so on and so forth. Okay, so this is a very important element in a PPP, and because of this shared ownership, the public agency and the private company become partners. Okay, so become partners of the entity, and as partners both of them pool resources together and share risks and rewards to create efficiency in the production and provision of public or private goods. Okay, so the important thing is they pool resources together, right? So private sector will have some resources of its own, the public sector will have some resources of its own. Now when I talk about resources is simply not capital. Okay, capital is one resource, but then there could be other types of resources as well. For example, you can talk about expertise, right? You can talk about human resources. So all of them are resources of one kind or the other. So each one of them pool resources that they have or that they are best at, and they also share risks and rewards. So there are several types of risks that the project has, and the risks are shared between the different parties in the partnership. So each and every partner will share the risk that they are best capable of managing. Okay, and they also share the rewards. For example, if the project is doing very well, then the rewards are shared between different partners, and the objective of this is also to create efficiency in the production process. So how do you actually create efficiency? Efficiency can be created in several ways. Efficiency can be created in terms of promoting competition, efficiency can be created in terms of providing incentives for the partnership to function in such a way that people are incentivized to perform better and so on. In the provision of public or private goods, the partnership can come together either for a public good or either for a private good. So it can actually be for, let us say, for creation of a public infrastructure, like let us say a transmission line, or it could be in terms of setting up, let us say, a public school, or it could be for certain private goods as well. So essentially we are talking about a partnership between a public agency and a private company. The second feature is when you really look at it, PPPs are separate organizations on their own, okay, rather than bargaining relationships. Okay. In a traditional public procurement, what do you actually see? Okay. So in a traditional procurement, so there is a government, or let us say a public sector, and the government wants to actually, let us say, procure some goods or services, and then there is a supplier, which is, let us say, the private sector. So when the government wants to procure a certain amount of goods or services, the government approaches the supplier, right? The government approaches the supplier, and the supplier in turn provides the goods and services to the government. So there are several ways in which the government can identify the supplier. It could be in terms of competitive bidding, or it could be in terms of targeted identification of the supplier, and so on and so forth, right? But essentially what you actually find in a procurement kind of an activity is they are distinct organizations on their own, and then there is a lot of bargaining that happens between these two. Okay, so it is a bargaining relationship, right? The government and the supplier, they bargain with each other. So they are two separate organizations that continue to exist. Okay, but in a PPP, what actually happens is you actually create a separate organization, right, where you actually have both the government and the private coming together, right? We have both the government and the private coming together to form a separate organization, right? This is a separate organization, and it is not two separate organizations as it was in the previous case of public sector procurement, right? And when they actually form a separate organization, they are not governed by the traditional bargaining relationship, because they are in it together, and they will actually have to share the risks and rewards depending on the way they occur. The main feature of a PPP is shared authority and responsibility. So in a traditional public sector procurement, the government actually has what is called as a lot of authority, right? The relationship is mostly one way, but in a PPP there is a shared authority, and then there is a shared responsibility as well, right? And to ensure that there is commitment of both the organizations to the partnership, in most cases there is a joint investment, there is sharing of liability, and then there is a mutual benefit, right? So these are important cornerstones of a public private partnership. How does it differ as compared to a traditional procurement? Okay. So we need to actually understand this in a little bit more detail to appreciate the philosophy of public private partnership. Okay. In a traditional public procurement, what happens? The public sector essentially buys an asset. Okay. So they want to, the government wants to create, let us say the government wants to construct a power plant. The government makes calls for a bid, and then there are interested people who actually come and they actually make a bid for constructing the power plant, and then the government actually pays the price for the construction, and then the government at the end of it all gets a power plant. Okay. So what actually happens at the end is the government gets a power plant, the government buys an asset. So that is the traditional procurement. The ownership of the asset rests with the public sector. Okay. Whereas in a PPP what actually happens is the public sector purchases a stream of services under some specified terms and conditions. Okay. Instead of actually procuring an asset, instead of actually buying an asset, in a PPP government actually purchasing a stream of services. Okay. If the same power plant is being constructed by the private sector, and if the government is actually purchasing the power from the power plant, then it is purchasing the services, it is not actually having the power plant as an asset. Same is the case with the road project. If the public sector procures construction of road services from different construction firms, then after the suppliers have been paid off, the road becomes that of the public sector. So it is actually bought an asset, it is actually constructs and develops an asset. But in a PPP what actually happens is the government procures transportation services from the PPP organization that has actually constructed the road. So there is a very distinct difference, and it is also what is called as a mindset change. Okay. The traditional mindset is to acquire an asset, but in a PPP the mindset is to actually acquire a service. We also have to really look at PPP as encompassing the entire project life cycle rather than individual components. Okay. So in the traditional procurement setup, what really happens? There are different components to a project, right? There are different components to a project. For example, you will have design, right, and then you will have engineering, then you might actually have construction, and then you will actually have operations, and then you can actually have maintenance, yes, a project can have several components like this. So let us say engineering and equipment as well. So in the traditional procurement system, what would the government do? So the government engages a vendor to provide design services, the government engages a vendor to provide engineering and equipment, the government engages a vendor for construction, the government engages a vendor for providing operations, and then engages a vendor for maintenance. So essentially you will have multiple relationships that are going to be part of this project process, right. So when you really have this multiple relationships, each one of them might not really look at what is going to be happening after their involvement in the project is complete. So for example, the construction can actually be focused on how can they actually achieve or complete construction at the lowest cost, but a construction that is completed at the lowest cost might not necessarily be effective when it comes to operations, or it may not actually be effective when it comes to maintenance. So a low cost construction might actually result in a higher maintenance, or it may actually result in a higher operation cost. So similarly when you look at design, a design that essentially provides for a low project cost, it may not be actually very effective when it comes to overall maintenance in the longer term. So each one of those project activities will be more concentrated on achieving low cost for their individual components rather than looking at a project as a whole. Now when we are talking about public private partnership, a public private partnership looks at all of these aspects pertaining to the project. So the project is responsible for achieving maximum efficiencies across all the segments, right. So one is possible to look at the project as entire life cycle rather than the individual components. So the PPP is able to look at a design not in terms of low cost, but in terms of what is most effective through the entire project life cycle. A project design might be expensive, but then if it is actually result in corresponding benefits in terms of low maintenance or most efficient operations, then it is actually better for the project for the life cycle. It is more cost effective through the life cycle rather than just being low cost upfront. So this is another difference between the traditional procurement and PPP. In a PPP, one is able to look at across the project life cycle rather than looking at as individual components. Let us look at some of the distinguishing features of PPP. First, we have to look at participants. So a partnership essentially means that there are more than one entity, otherwise it is not a partnership, right. And what kind of partnership we are talking about? We are talking about a public private partnership, right. So in a partnership there has to be both a public as well as the private sector, right. So there can be many partners, but at least one of them should be a public body, right. If there is no public body in the partnership, then obviously it cannot be called as a public private partnership. Okay. So this is an important one, at least one party in the partnership should be a public body. And in addition to being part of the partnership, there has to be some kind of organizational commitment to be partnership. It is not you are just there for the sake of it, but you are committed to the success of the partnership. So that is very important. The second aspect is relationship. Okay. The partnership should be enduring and relational. So in the sense that there has to be some kind of relationship that has to be built, that has to develop in the arrangement. See, for example, a public sector will essentially have different kinds of suppliers, right. So if the public sector body were to use the same supplier year after year, that relationship will still not be considered as a partnership. So for example, let us say a government has an arrangement to, let us say, provide let us say lunch for the officers in the office, right. So even if the same vendor provides lunch for several years, that will still not be a partnership kind of a relationship, it will still be a vendor kind of a relationship. So in a PPP we are looking at a relationship that is much more stronger and that is much more enduring. The third aspect is resourcing. Each of the partnerships must bring something of value to the partnership. Okay, if the partnership has to sustain, there has to be an absence of what is called as a free rider or a pillion rider, right. Each and every partner who is part of the PPP should bring something of value. Okay. So let us look at the example of the Bangalore International Airport. So when the concession was awarded for Bangalore International Airport Limited, there were the following shareholders in the partnership. So there was KSIIDC, which was the organization of the government of Karnataka, then there was the Airports Authority of India, and then we have Larsen and Toubro, then we had Siemens, and then we had Zurich Airport, right? We had Zurich Airport. So each one of the participants, each one of the partners bought something of value to the project. So for example, KSADC was able to actually coordinate the availability of the land for the project. So that is a very important element for the project. So KSADC was responsible for getting that land, in addition to facilitating various state governmental clearances. Okay, so it brought something valuable. Airports Authority of India is an organization of the central government, and Airports Authority of India is responsible for the traffic, responsible for navigation services to the airport. So they actually brought something in addition to several other support services they can in terms of facilitating governmental clearances from the central government level. Then we had L&T. L&T was responsible for construction, so they brought something in terms of construction expertise for the project. And then we had Siemens. Siemens is the equipment supplier, so they actually brought in value in terms of equipment for the project and knowledge associated with operating the equipment for the project. And then you have Unique Zurich. Unique Zurich had experience in terms of airport operations, and operating an airport is a lot more complicated than many assets or than many other projects, and that experience of airport operations is an important value to the partnership, and they actually brought that value. So if you look at it, each of the partners in the PPP actually added certain amount of value. So this is very important. This kind of resources, bringing resources, is very important in a PPP. Sharing. PPPs involve a sharing of responsibility and risk for outcomes in a collaborative framework, right? So one has to be in a position to share the risks. So each of them should be in a position to absorb the risks which they are best able to manage. So for example, acquiring land for the project might be very difficult for a private company like L&T or Siemens to absorb. So therefore the responsibility for acquiring land fell on KSAIDC, because they were best equipped to obtain the land for the project. Similarly, in terms of ensuring operations, quality of operations was actually the responsibility of Unique Zurich. So there is a shared responsibility among the various partners. And we also have what is called as continuity. There is a contract framework which sets out the rules of the game. So in essence, it kinds of avoids being exposed to the idiosyncrasies of the political environment. So when there is a change in the political environment, then there can be substantial changes in the policy and so on. But in an infrastructure project, there is substantial investment that is made by the private sector, and these kinds of frequent changes in the policies can actually affect the investment that is made in the past. So to ensure that any policy changes does not affect the investments made in the past, there is a contractual framework that is actually governing the partnership, and this contractual framework sets out what is called as the rules of the game. Okay, what are the different rules and responsibilities of the different partners, under what circumstances can the license or the concession agreement be revoked, and so on and so forth. Okay. While it needs to be understood that it is not possible to specify upfront all of the outcomes and specify what will be the result for each of the different cases, a general framework will give a lot more comfort to the private investors as compared to leaving many things open-ended and broadly, if you look at classification of PPP, they are classified in in 4 categories. This is actually a classification that is being done by the World Bank. So the first is called as a management and lease contracts. So in a management contract, private sector management takes over the operations of a public sector entity, and the public sector entity pays a fee to the private sector for providing management services, and the entire risk of operations is borne by the public sector, right. So there is a guaranteed fee that is provided by the public sector to the private operator. In a lease contract, the facilities are leased and the private sector assumes a responsibility for managing the facility. So in this case there is no fixed fee like we see in the case of a management contract, but the operational risk is actually managed, operational risk is actually borne by the private sector. So if there is excess profits, the excess profits are actually shared by the private sector and the public sector, but at the same time there is no guaranteed fee income like in the case of a management contract. So the second type of PPP is called as concessions. The various build, operate, transfer, build, own, operate, transfer. So the concessions that we normally have seen earlier in we talked about project structuring, they all also are some forms of PPP. And then we have greenfield projects. Greenfield projects where there is public sector participation. For example, we talked about the Bangalore International Airport. In the Bangalore International Airport, there is public sector participation in terms of Airports Authority of India and then KSIADC. So this also becomes a PPP project. So whenever we have greenfield projects where we actually have public sector investment in terms of capital as well, they are also called as joint ventures. Okay, and in a concession, in most cases there is no public sector investment. So public sector gives a concession, they actually give a license to the private sector to operate the facility for a certain amount of time, but there is normally no financial investment being made by the public sector. But in a greenfield project and in a joint venture specifically, there is capital invested by the public sector as well. And then the fourth category of PPP is divestiture. Divestiture involves a sale of existing public sector entity. It can be either 100% sale or it can be a partial sale of shareholding, right. In both of these cases it is called as a PPP. Okay. So before we end today's lecture, I have a couple of thought questions. The first question is, what are the reasons behind the implementation of PPP projects, right. We are seeing a lot of projects being implemented by PPP. Not a day passes without seeing some news about PPP or other in the newspaper. So why there is such a move, such an interest in terms of implementing PPP projects? And second, what do you think would have been the impact of PPP? So we have actually been implementing PPP projects for several years now. In some of the developed countries like the UK, the PPP has been implemented for the last 2 decades or so in a very active way, and in developing countries at least for the last 10 years there has been substantial interest in implementing PPP projects. So the question is, what do you think would have been the impact of PPP so far? Okay. So we will spend some time discussing these questions in the beginning of next lecture.